Welcome to Chapter 7 of our AFS course. This is a logical continuation of the discussion we have been having. We looked in the previous chapter, Chapter 6, at the income statement, and now we will turn our attention to the second major financial statement, that is the balance sheet. And so the overarching question is, how do we analyze a balance sheet? And so I invite you to come along with me as we look at some of the key techniques that should be used, basically the questions that should be asked and answers provided as part of your analysis. When analyzing the balance sheet specifically, we are asking questions regarding the financial condition of the firm. So we're looking at the status of a business at a specific point, specific day. How accurate are the numbers reported on that particular day? And do they reflect a strength or a weakness for that particular economic entity? So here we go. We're asking, what are the major concepts that we should be aware of regarding the components or elements of the balance sheet? First of all, the balance sheet is a summary report that shows the financial position of a business or an economic entity, could be a person, on a specified day. So it's not covering a period, it's for a specified day. It shows the assets and who is claiming those assets. And that is where we get our fundamental accounting equation, which says in simple terms that total assets should be equal to total claims. What are assets? Well, in simple terms, assets are items of value that are owned or controlled. And the key question that we will have here is, how are these assets valued? On the liability side, we're looking at claims against those assets by an outside entity or by outsiders. And so you would not include amounts owed to the owner in this particular category. And then for equity, we're looking at claims against assets by the owner. And so at any point in time, total assets should be equal to the sum of the liabilities and the equity. Another way to look at this is, this business or economic entity has $500,000 of assets, and 100,000 of those assets were funded by outside sources, showing that we owe 100,000, and 400,000 was funded by the owner. That would be the financial position on that specific day when these numbers were extracted from the records. So now we want to look at the major components or categories of the balance sheet. Of course, you have assets, but those assets can be further subdivided into current assets and non-current assets. And in simple terms, current assets are those assets that are expected to be converted into cash or used within the operating cycle. There's that phrase again, operating cycle, or the fiscal period, whichever of those is longer. And so you will classify those items as current assets. Non-current assets are those assets, fixed assets, sometimes they are called, that will be on the books for several fiscal periods or operating cycle. We can also break down the liabilities into current liabilities and non-current liabilities. Current liabilities in general are liabilities that are expected to be repaid from the conversion of current assets. Hold on to that concept because it's going to prove very helpful when we get into ratios. So current liabilities are those liabilities that are expected to be paid from the conversion of current assets. And your non-current liabilities would be those that are going to be repaid over a longer period of time. And of course, the equity, which is the amount claimed by the owner, is going to be comprised of the amount invested by the owner plus or minus any profit or loss that would have been earned or incurred over the life of the business to date. And so examples would include cash and equivalents, accounts receivable, as well as inventory. These would be examples of current assets. And normally these assets are listed in the order of liquidity, which means you start with the most liquid current asset and you end with the least liquid. Do not be surprised if you see prepaid expenses included in this category, even though for the purpose of analysis, such items tend to be excluded. But in general accounting principles, prepaid expenses would be part of your current assets. So again, current assets are listed in the order of liquidity, the most liquid to the least liquid. Why is inventory coming after receivables? Because receivables result from the sale of the inventory. And so we are closer to the conversion process to cash in the operating cycle compared to inventory. Recall that with the operating cycle, we use cash to purchase inventory. We will then sell the inventory. If it's on credit, then we create receivables and then we collect the receivables. So inventory would be considered to be less liquid than accounts receivable. These are examples of items that would normally be recorded as non-current or fixed assets: land, property, plant, and equipment, leasehold improvements, and of course, intangibles. Depending on the specific situation, sometimes these may be in a separate subsection titled intangibles, but basically they are part of the non-current assets. Similarly, we have examples of current liabilities. The classic examples are accounts payable, short-term notes payable, and accruals. Accruals, as you may know from your accounting, are expenses that have been incurred but not yet paid. And so we have these liabilities, they should be repaid from the conversion of the current assets. What are long-term liabilities? Again, debt to outside entities, but they are classified as long-term because they will not be paid within the fiscal year. So more than a year would be the term associated with long-term debt. You could also find there what is called subordinated debt, which would be a debt that is given a lower priority over other debt. Sometimes you will find that situation with a bank where a particular loan to one entity is given a lower priority in terms of repayment, so it's said to be subordinated to others. Sometimes you will see in this category deferred tax liabilities. Recall that we talked about that when we discussed the financial statements in chapter 5. And then we have, of course, the equity section, which is comprised primarily of the capital and the earnings that would have been accumulated over the life of the business. Sometimes there will be a statement of retained earnings, which will give us details regarding the makeup of the retained earnings. But essentially, this would be beginning retained earnings, subtract any dividends if the company does in fact pay dividends, and then you would add the profit for the current period. So it could be also retained earnings, beginning balance, plus profit, minus dividends, and you get your ending retained earnings. What I am sharing with you is one way that the balance sheet can be presented. This is called the account form, and it's called the account form because you have assets on one side and liabilities and equity on the other. There's another format which is called the statement or report form, where you have assets listed first, and then below that would be your liability and equity. It's a stylistic question, and it has nothing to do with the accuracy or lack thereof of the financials. So this is in the account form. And so you can see the current assets, examples, cash, petty cash, temporary investments. So these would be what we call cash equivalents. And then you have accounts receivable, inventory, supplies, prepaid expenses. These are all current assets, and they're listed in the order of liquidity. And then we have between those two long-term investments. So these would be relatively liquid assets. Maybe you have the company investing in stocks or bonds. And so we separate them because they are not expected to be used up during the normal operating cycle, but represents a cash resource if the business were in fact in need of additional cash. Here are your non-current assets. You have property, plant, and equipment, sometimes referred to simply as PP&E. And you can see land. And then you have land improvements. There are buildings, and so on. But all of these would be your non-current assets. And notice in this example that they have a subsection for intangibles because they may have several, as in this case, they have goodwill, which is the most popular form of intangible. Goodwill results from the sale, or in this case, the purchase of another business, and you paid an amount that exceeded the book value of the net book value of the asset. So let's say you had a business that was sold for $600,000, but the net value of the assets was $500,000. You would have $100,000 reported as goodwill, and this would be on the books until this business then gets sold. There's also another type of intangible. In this case, they have trade name, copyright. All of those are examples of intangibles. On the liability side, we have current liabilities, and these are debts that should be paid from the conversion of current assets. And so theoretically, you would want to see more current assets than current liabilities. However, as part of your analysis, you would be looking at the current assets in relationship to the current liabilities. And just going back to the point about valuation, we would want to know what is the basis for the values on these assets. For example, land. This is not the current appraised value of the land. It would be the value of the land at the time it was purchased. So we're looking at what is called historical cost. Whereas something like your investment account would represent the value of that investment, current value at the date of the balance sheet. So if it were stocks, it would be valued based on the closing price of the stocks on the balance sheet date. So my point is that there are different methods used to value assets, and you would want to know which method is being used. We briefly discussed inventory in the chapter on the income statement, and recall that if they use the FIFO or the LIFO or the weighted average, it will affect the value of the inventory. That is why you want to pay attention to the notes to the financial statements. They will always tell you if the financial statements are externally prepared, that the notes to the financials represent a critical component of the financials. So you do not want to separate the notes from the financials. They should be read, the financials should be in conjunction with the notes to the financials. So these are the current liabilities, and we then have the long-term debts. And in this particular example, there is no subordinated. So the total liabilities we see here, and then we have the equity section. Recall that the business structure affects the presentation of information on the balance sheet. So if this were a sole proprietorship, you would still have a stockholders, you would still have an equity section, but it wouldn't be referred to as stockholders' equity. It would simply be captioned owner's equity. So the change is dictated by the structure of the business. Same thing if it were a partnership, there would still be an equity section. However, the title for the descriptors would be different. So it would be telling us about partners' capital as opposed to stockholders' equity. So the terminology changes, but the essential concept is still that of total equity. So total assets should be equal to the sum of total liabilities plus total equity. If that equation is out of balance, then we know that there is a problem. For example, when companies file for bankruptcy, one of the characteristics will be that their liabilities exceed their assets, which means that equity would possibly be negative in that scenario. How do we analyze the balance sheet? As I said, questions should be the main focus as you go through the balance sheet. But again, you want to analyze the balance sheet in relation to the income statement, because what is reported in the income statement impacts what we see on the balance sheet. For example, if the firm has sales on credit, we will see the sales in the income statement, but the unpaid portion of the sales would show up in the balance sheet as receivables. If the firm had expenses, we would see them reported as deductions from revenue in the income statement, but any unpaid expenses would be reported in the balance sheet as liabilities. So you do want to analyze the balance sheet with the corresponding income statement available to you. It's not really meaningful to be looking at one without the other, given the interrelationship among the two. In fact, the interrelationship among the three, the statement of cash flow being the third. Also, there are analytical tools that were mentioned in a previous chapter. Common sizing, where you would take each item on the balance sheet and express it as a percentage of total assets. You can then use that for trend analysis to see the direction in which the percentages are going. Are they increasing, decreasing? And of course, the question then would be why. So you can do a trend analysis. You can also do a comparative analysis where you compare either company A with company B, or you compare company A with its historical data. The other tool available to us is ratios, which we will focus on in a later chapter. As I have been doing, I will give you a scenario and you tell me if you think it is favorable or unfavorable. The first one we have is net sales increased 5% in the last 3 years, and accounts receivable increased by 6%. So we're looking at what's happening with the income statement, sales, and the balance sheet receivables. Is that favorable? The question really would be, what caused the scenario? And so if we find that the firm changed its credit policy to allow more time to pay receivables, then it tells us that it's not that they are selling more on credit, it's that they are allowing a longer time for the receivables to be collected. That has cash implications, of course, because it means then that they may have to borrow in order to fund that gap in time from the sale to the actual collection of those receivables. Here's another scenario. Net accounts receivables have been decreasing, and this has been the case each year as a percentage of total assets. Receivables going down. Are they collecting faster? Are they not selling as well? Are they selling more on cash basis as opposed to a credit basis? Questions, questions, questions. What if we found, based on our questions, that the firm decided to aggressively increase allowance for doubtful accounts? This is where the firm makes the decision that a percentage of their receivables will not be collected, and as a result, they take that allowance away from the gross receivables and they show the net. So we know then that the decrease is not from a favorable situation. Not only are we learning that they are not collecting, they have determined that they will not most likely collect on the amount that's outstanding. Again, major cash flow concerns would be represented by that scenario. How about scenario number 3, where the trend analysis, one of the tools available to us, reveals that net fixed assets, which is the book value of the assets minus the accumulated depreciation. That's how we get to the book value. We take the original cost, subtract the accumulated depreciation, we get the book value. Book value is literally what it means, the value on the books. It doesn't tell us what that asset can be sold for necessarily. So we're told that the net fixed assets, which is original cost minus the accumulated depreciation to give us the book value, has been decreasing at an increasing rate over the last 3 years. Basically, it has been going up and it's going up faster each year. Sounds good? Is it because they are expanding and so they're having to purchase more fixed assets? Again, questions would have to be asked, And we were told from our questioning that management changed from the straight line method to an accelerated depreciation method. So this data, this information introduces something that you may already have known from your accounting, that there are different methods for depreciating assets. Straight line, where the same percentage is depreciated every year, 5%, or a fixed dollar amount, versus an accelerated depreciation where the amount that you depreciate is large in the early years and then it declines. Both methods are acceptable. You will need to know which method is being used by your client because it impacts what shows up on the income statement as an expense for depreciation and what gets reported on the balance sheet as accumulated depreciation. Hence my statement earlier that you do want to analyze the balance sheet in light of what you have gleaned from the income statement. Fourth and final scenario, common size balance sheet. Remember, this is where we take each component of the balance sheet and express it as a percentage of total assets. Let's assume that it shows a significant increase in total inventory in the current year. Buildup of inventory? Are they anticipating a new contract? Or are they building up in anticipation of the season, depending on the date of the financials? Again, questions would need to be asked. We learn that the firm increased its purchase of raw materials, so this is a manufacturing entity, in preparation for a large new contract that was signed. So we know that this significant change is not their norm. It is due to a specific event, and so it would be considered as favorable. I do hope that you find the information to be value added. Reach out to me, please, if you have any questions regarding the content.